Hello, everyone. Thank you for joining us today on our webinar, Under the Hood. We're going to shed some light on some of the risks that even really financially savvy people unknowingly take. Share how a team of advisors with over 90 years of experience thinks about risk. And then we're going to cover a few basic tenets of risk taking and how to overcome risk. We're going to go ahead and get started right away here. First, a few introductions are in order. My name is Connor Hartman. On the far left there, became an advisor in 2016 at Conestoga after graduating from Duke University. To my right is AJ Tebow, certified financial planner, managing partner at Conestoga Wealth Partners. Been an advisor since 1995, founded Conestoga in 2010. To the right of AJ is Jim Shockman, certified investment management analyst, co-founder of Conestoga with AJ. He's been an advisor since 1987. And then to Jim's right is Perry McLean. Perry also joins us with a wealth of experience, over 30 years in the business. As you can see, a tremendous amount of knowledge and experience here. Without further ado, here we go ahead and get started. So, today I think talking about risk, it's kind of helpful to think about the metaphor of potholes. Those things that we can accidentally run across without intentionally trying to. We can run into some speed bumps, if you will. There's a lot of things that we can worry about, a lot of what ifs. Of course, some of them would be pretty bad if they happened. Most of them, fortunately, aren't very likely to happen. And, while we can find ways to deal with these what ifs, we don't have enough time, money, resources to do something about all of them. And so as financial advisors with decades of experience, we have a pretty informed perspective about the biggest risks, at least in the financial space. We tend to know the risks that trip people up the most, as well as the ones that people don't realize they're taking. We even have a decent amount of experience with seeing people who recognize there's risk and doing something about it, even if it may not make sense to do so. So today we'll talk about those biggest risks that we see and spend some time on how to approach and handle risk in general. Without getting too far into the details here, these are some of the risks that we're going to cover. I figured, AJ, you could start us off maybe talking with us about interest rate risk and what that is.
Sure. So when we talk about interest rate risk, we're usually referring to fixed income investments or bonds. And bonds have several different types of risk, but we're just going to talk about interest rate risk right now. And it's the relationship with interest rates and the value of bonds in the marketplace is literally like a mathematical seesaw. So and the reason is because a bond is a loan. Think of it as credit. And you as the investor are the creditor, and the issuer, whether it's a county, city, county, state government, or the federal government or corporation, they're the debtor. So they're borrowing money from you in the form of a bond and promising to pay you back at a certain date called maturity. And in the meantime, they're going to pay you a fixed rate of interest. And it's the fixed nature that causes the value of bonds to fluctuate. So as interest rates go down, prevailing interest rates in the marketplace go down, the value of existing bonds with that fixed rate will actually go up if you wanted to sell it in the marketplace, because the value of that bond is worth more because it pays higher than prevailing interest rates. And the opposite is true also. If interest rates are rising, well, then the value of your fixed rate bond is worth less in the marketplace if you wanted to sell it before maturity, because it's paying less than prevailing interest rates. So a lot of times we'll see bonds that can be even more volatile than stocks.
Great. Yeah, a little contrary to popular ideas. Great stuff, AJ. So Perry, maybe you could touch on purchasing power risk for us.
think I got this slide because I'm so old, because I can remember some of these things that are on this slide. I used to remember buying gas for 29 and 30 cents a gallon. I bought my first home in the early 80s and the interest rate was 12+%. So I remember some of these inflection points that we've had, but purchasing power risk really has to do with, it takes more dollars to buy the same goods. Typical example, I remember, as a young man going to McDonald's, and with less than $1, you could buy a meal. And now a meal at McDonald's is probably going to be between $8 and $10. College tuition, as those of you who've had to put children through college realize that that's a very large outlay of cash. My first and second year in college, I went to a private university, and my first year was $2,500 and my second year was $3,000. So that would go a long way today in purchasing any tuition. So
at least 10 times that.
Easily.
Yeah, no, it's really gone up a lot. Yeah, you are dating yourself. I can remember 29 cents a gallon at a self-serve, and putting $2 in a friend's car to give me a ride to my job where I got paid at $1.50 an hour, which was the minimum wage.
Yeah, times change, right? I guess that speaks to the power of, you don't want to be too conservative and have all your money in that bank account that's getting 0%, right, Jim?
That's right. I had, this reminds me of a story. When I was younger and just starting out in the business, I was talking to this fellow that didn't have a lot of money, but I was talking to him. He was 90 years old, and he told me he was investing in 1929, which I thought was pretty awesome. According to him, when I asked him, I was kind of curious. I said, so, you've been around for a long time. You've been investing for a long time. Do you have any advice for a young guy like me? And he said, well, my biggest mistake was being too conservative. And he said, basically, it's cost me a lot of money. And it's really affected my lifestyle now. And I never forgot that. I think that's a good example.
Yeah, absolutely. Got to make sure you take on enough risk to get, some kind of return, right?
Yeah, it seems like today you've got plenty of money, but, as Perry was saying, prices change. And I think it's, if you're buying a iPad or you're buying a computer or a phone, the prices on those probably go down. But really, the only people that could probably get by are people that don't use healthcare, that don't eat, and don't drive. And those are really the three biggies when it comes to inflation.
Yeah, no kidding. Yeah, and so, taking enough risk, that's important to do. We don't want to lose it out to inflation. It's kind of funny. Another type of risk that we're covering here is concentration risk. That's almost on the other end of the spectrum, going too far out on one limb. We actually see this a lot with people who work at companies that are growing quickly. And they often will offer ownership in their company to their employees. They can wind up with stock options, employer stock, pension, health and insurance benefits, and of course their own income, all coming from the same place. And I kind of liken the investing strategy and just the way you think about risk. It's kind of like a tree metaphor. You can grow tall and fast if you just have one limb, and there's a lot of potential there. But if something happens to that branch and you don't have multiple branches and a decent root system, you can easily set yourself back a ways. You magnify your risk by being concentrated, and it's something that you can eliminate. If you have, many different positions that all have potential, you can actually eliminate that specific risk of that one company going out of business or something happening. And this goes for both stock and bonds. Diversification works well. The stock market, if you have ever seen a graph of what the stock market looks like, there's tremendous growth over time, but very few individual companies have actually withstood that passage of time. I'm sure we can all remember companies that used to be the latest and greatest, and now they're gone, to the winds of time. But
Kodak and Polaroid,
yeah,
and a
exactly.
couple.
Perry, maybe you could tackle economic risk for us. What is that?
Economic risk really has to do with government and political and countrywide situations. When Connor and I do some of our work at the local university, one of the things we always tell the students is to make sure you understand what your political leaders are talking about doing when it comes to affecting the economy, because it does have an effect on your investments and your wallet. So higher taxation reduces wealth. Different kinds of programs that they put in place that can help certain industries and hinder others. You know, and you've got to worry about situations where, for instance, my mother was from Germany, and after World War I, and she was born right at the beginning of World War I, there was massive inflation where literally the prices in a grocery store would change by the hour, and you would have to bring in bags of money to effectively buy your groceries for the day. And we've never seen anything like that. But as the U.S. piles up more and more and more debt, that could substantially affect what might happen to our economy. So the keynote here is to just make sure that you're watching out and paying attention, and in our case, voting for those people who represent your ideas of how to make the economy work.
Yeah.
Yeah, I have a little story that my German friends told me. They said after, you know, during the hyperinflation, he told me his grandfather said that a man had a wheelbarrow full of cash, of marks, and lots of marks, completely full, and he stopped to go into an outhouse, and when he came back out, the money was laying on the ground and the wheelbarrow was gone.
Yeah, well said, Jim. Yeah.
Geopolitical risk. Yeah, this actually is a pretty easy one. You know, all these things are going on right now, trade conflicts, you know, wars and rumors of wars, civil unrest. And those can have profound effects on economies and on companies. And I don't, like I say, I've actually got a pretty easy risk to go over because it's very recent and we're kind of in the middle of it right now.
Yeah, all too true, right? Just turn the television on. I'm sure you could find what you're looking for if you were trying to get into this.
Turn the TV on and you'll see examples of all these.
Yeah. AJ, you know, legislative and policy risk goes hand in hand with that. Could you maybe talk about that?
Yeah, and thank you for giving me such a difficult one. For most people don't understand how this works, but the risk with how the Federal Reserve manages monetary policy, and they have an incredible amount of control. You know, one example would be back in the mid-late 90s when Alan Greenspan made the irrational exuberance comment and set the markets off. But basically, they manage monetary policy in a few different ways. One is by changing interest rates. So if they think that inflation is increasing, they're going to want to increase interest rates to make it more difficult to borrow. It's more expensive to borrow, and that's they're trying to reduce people's spending. And in times of recession, like we're in right now, they're doing just the opposite. They want to keep rates low to keep people spending, keep companies spending. So the goal is to maintain balance, a healthy rate of growth, not too fast inflation and not too slow, which equals recession. So the Fed can also affect monetary policy by changing tax rates. You know, higher taxes are going to discourage spending because people have less, companies have less, and lower taxes will encourage spending. And a good example of that is what we're seeing right now with the recent CARES Act that responding to the coronavirus. I mean, they're infusing trillions of dollars into the economy to maintain spending at a time when we've got record high unemployment. Now, of course, all this is temporary, but it's had a tremendous positive effect.
So where are they getting that money from, AJ?
Borrowing.
Borrowing. So we're gonna have to pay it back at some point, which I'm guessing that probably I wouldn't be betting against lower tax rates in the future.
It's true.
And that's certainly a risk as well.
Yeah. Well said, you guys. Yeah, well, I know if I was in the 40s, I wouldn't want to be taxed at 80, 90%. So I'm glad it's at least lower than that today. Well said. Totally switching gears here. Another risk that we see a lot is the risk of just underinsuring, or even more appropriately, just misinsuring. We actually see a lot of people who overinsure too. And this has to be one of the things that we see mismanaged the most often. People are insuring the wrong things or paying the wrong amounts, sometimes misinformed. I find it interesting in Washington, at least, there's a lot of people running around with car insurance that actually insures others more than themselves and their own families in their vehicle. But something to keep in mind too is that, the house on average always wins. The insurance company will come out ahead, but that's okay. We don't pay insurance to usually, hopefully not, try to outsmart the insurance company. But we pay premiums to keep ourselves from having to pay for those things we just can't afford to have happen to us. We instead spread the risk around. And we see a lot of issues with some of these, especially one of the common ones we see is life insurance. I mean, we see people who don't have life insurance and they should. And we also see those who continue to carry policies when they really don't need it anymore. They don't need to insure that income that they were going to generate. It usually takes financial planning to figure that out, though. And that's why sometimes there's this kind of asymmetry between what we should have and what we actually have. And also, I will say that there's a lot of emotion in this too. There's a big emotional component to insurance. It handles a lot of, just big events that could happen to us that we don't want to think about even. So definitely a real risk that we see on a regular basis. AJ, speaking of tough topics here, maybe you can tackle sequence of return risk. And Jim, feel free to jump in here.
Another tough one, and this is really more Jim's bailiwick, but so Jim, feel free to jump in here. But essentially, sequence of return risk has to do with negative returns early in a period when withdrawals are starting. So say somebody just retires, and there's a big downturn in the market, and they're taking money out. So there's that danger in timing those withdrawals. And there's ways around this. One way is to plan in buckets so that if we do see a downturn, we're not taking it from areas that are subject to market volatility. So that most the earlier bucket would be cash and equivalents. So we think of it as kind of three general categories: liquidity, longevity, and legacy. So that first bucket is going to be the most liquid. And another way is to plan for to create income in non-market sources, say from an annuity or laddered bonds. One strategy that is pretty popular when we're going through the planning process for people is to take larger distributions from assets so that we can get people to age 70. Well, we need to plan for that so that we're not subject to the market and taking larger distributions more than the accounts will sustain. So that's all things that we do in the planning process.
Yeah, I think the most interesting thing with this chart is we're looking at, first of all, starting with the same amount of money. The second thing is we've got exactly the same returns over that period of time. The only difference is the bad years, which came at the end in the blue chart, we just switched the returns around. The average is exactly the same for both plans. So if you looked at it, looked at the investments, you'd see that you got a 6.6% return. The only difference is we just switched the returns around and started with the bad returns instead of the good returns. Same exact time, same exact returns. The only difference is withdrawals early on when the market value is down. You can see it makes a huge difference.
Yeah, no kidding. That's a big difference. Kind of something along the similar lines here as time horizon risk. I mean, when you need the money and even your estimate of when you're going to need the money. I mean, that is subject to change. There's a risk that could be different than what we think it will be. It's kind of funny. I mean, maybe you guys can already tell what this is, but the top right there, a positive pregnancy test maybe a few years earlier than we planned for. I mean, that's it's a wonderful thing to have a son or a grandchild or something like that happen sooner than you planned in some ways, but in terms of needing the money to fund some of those things, can throw a wrench in the works. And the same thing goes for longevity. I mean, people are living longer and longer these days, and there's always that happy risk that you're going to live an extra long, happy, healthy life. You want to make sure that you can plan for that eventually, that possibility. You just never know. So, in kind of going hand in hand with this, when you talk about risk, and sequence of return risk is a great example of this. When you need the money actually helps determine what risk is. Movements up and down, fluctuation, over the course of a year, that's a big deal. If you're looking to buy a house in 6 months, you probably don't want to lean towards more aggressive, maybe like equity investments that are going to fluctuate in value potentially. But if you're investing for 20 or 30 years, it really doesn't matter what happens in the first year or two in terms of ups and downs. What matters is your long-term return. And that's why, risk is relative, and it's not always the same thing as volatility. There's a difference in that. Especially if you have 20 or 30 years until retirement, you can afford to usually be more aggressive. So another risk there that we just want to keep in mind. Jim, maybe you could explain what black swan risk is. Give us some examples.
As opposed to a black stork earlier. Really, a black swan is just an event that's hard to predict, unlikely. It's basically an unlikely surprise that can have a major impact both in the short and long run. We all know what unknowns are. Well, these are the unknown unknowns. These would be events like the pandemic that we're going through now. I mean, a year ago, nobody was talking about it. Nobody predicted it. But as we can all see, we're living through it now, and it's had a profound effect. 9/11 was another one. For you historians, World War I was a big deal. They can also they have impacts, but they don't have to be negative. The internet was kind of a black swan. Nobody really knew that was coming. It kind of came out of nowhere, and it changed the way we live in a relatively short period of time. Natural disasters around here, we have volcanoes, and earthquakes. Some places they have tornadoes, and I mean, you really never, they're going to come. You just don't know when they're going to happen. And these are things that can really have a profound effect on your life. These can happen on an individual basis too. Auto accidents are usually a surprise. Health issues are kind of individualized black swans. We know they're possible, but we don't like to think they're probable.
Yeah, definitely. Well said. So kind of switching gears here a little bit, we've been talking about a lot of different kinds of risks, but now as advisors, we often notice that there's a big difference in people's perceptions of risk, their comfortability with risk, how we perceive risk as individuals. AJ, I know this is a lot to speak on, but maybe you could talk to us a little bit about what we perceive when we're thinking of risk and what we see a lot.
Yeah, and I find this area really interesting because we deal with a lot of different types of clients with different attitudes about their risk. In the initial planning process, we'll ask the question, so what in your mind is a reasonable rate of return? And sometimes we'll get, well, 12%, and I don't want to lose any money. Well, that's not reasonable, right? And my first question would be, well, lose money over a year or 10 years? Because that, again, it's that perception. Obviously a year is a much shorter period of time, so the risk to get 12% is going to be much higher. But what we find is that there's this concept of risk homeostasis, where there's an overconfidence. And a good example of this is when anti-lock brakes were first introduced into vehicles. They thought that the instances of car accidents would go down, when in fact it actually went up, because people were putting too much confidence in the brakes and taking unnecessary risk. We also saw this in ship navigation. When navigation was invented in ships, the owners of the ships pushed the ship captains harder. Or with the Titanic, they were overconfident. They thought that it was unsinkable, and turns out it didn't take much to sink it. So,
and underprepared.
Yeah, absolutely. So as a general rule, and there's really not, I can't think of any exceptions to this rule. If something has a higher rate of return, it means it has a higher level of risk. And another thing that we find is with newer investors, when there's a lack of understanding, that lack of understanding causes anxiety and sometimes impatience. And we get the are we there yet? Where they're thinking just over a short period of time, maybe a year, they should have that what we're looking at is more of an average annual return.
Yeah. Perry, I'm sure you can speak to that a little bit too, with working with people who are new and trying to invest in a 401k, for example.
Well, yeah, I mean, in a 401k, one thing that they have the benefit of is dollar cost averaging, usually over a period of time. So you're buying in incrementally. So it almost helps if you've got a long time horizon if the market goes down, because you're able to buy shares in whatever you're investing in at continuing prices that may be falling for a while, but then return to go up. Another topic too is that, with zero interest rates and people trying to get returns on their money, it's made a lot more people willing to buy investments in stocks that perhaps didn't buy years ago. So that's created a whole new kind of dynamic for us now, because we've got maybe people drifting into an area that they weren't really comfortable in, but in order to get a rate of return, they're buying a stock because perhaps it pays a dividend and so forth. So one person's conservative is not the same as another person's conservative, for sure. And that's why it's important to have a good plan and use the bucket of money strategy, so that you can portion out your perception of what your money's going to be doing over time.
Yeah, absolutely. Thanks, guys, for weighing in on that. That's great. So kind of switching gears, again, going from the types of risks to ways that we can start to handle it, some rules of thumb that we have, 3 simple rules. I mean, these are really simple, but they go a long way towards informing us on how to think about risk. When we consider the odds, we think, what's the likelihood that something's going to happen? Is this something that we need to worry about? Or is it so astronomically unlikely that realistically we don't have to really do anything about that risk? We just have to say, you know what, it's really unlikely. And then, don't risk a lot for a little. It's kind of common sense, but we sometimes see people miss out on that in the investing world. Especially, Perry and I are in the 401k space sometimes, and talking to new people who are new to the 401k, new to investing, and they just look at their neighbor and they say, hey, you've got a little higher return than me. What does it take for me to get that return? And they might be, willing to risk a lot more than they should just to try to get that little extra. We've seen that a few times. And then don't risk more than you can afford to lose. I mean, that, again, common sense, but if there's something that you're not willing to even entertain the notion of that happening, and you think that there's a chance of it, well, that's when it makes sense to think about doing something about it. which is exactly where we're headed next. There's 4 different ways that we can do something about it, that we can deal with risk. And again, I like to use the pothole strategy, and a good way to think about this. So avoiding the risk, imagine finding a different road that maybe isn't quite as bumpy. There's less potholes, less chance of you damaging your car. Or you can reduce the risk, go slow, try to hit the least bad of the bumps if you can. And then retaining the risk, that's where you just plow ahead and you accept the fact you might just damage your car. Or maybe it's the Conestoga wagon if you're one of us. That's what spares are for, right? Spare wheels. And then finally, there's transferring the risk. You pay for insurance on your car, and if something happens and you hit that bad pothole, you're covered because you pay for someone else to take on that risk. These are 4 options that, they form the framework for making decisions about risk, and you can combine them together. They're not exclusive, but they actually tend to work best when they're combined together. I know, AJ, you can probably speak to potholes. I mean, you've got a dirt road that you maintain, right?
I do a good job maintaining the road, but I'm curious what Perry would do when his wagon lost a wheel on one of those potholes.
Those are some really big potholes too, and I'm wondering why they have it looks like a camera up above those potholes in this slide.
Yeah.
That's some pothole. It looks more like a meteor crater.
What's that, Perry?
Saddle up my horse.
There you go. Yep. Find a new path forward. Take the path less traveled. We'll go Robert Frost here. I remember my grandmother was having trouble getting up my parents' driveway. And she was like, nope, not even going to try. And she just persuaded them to have the road paved. And now my car sighs a moment of relief every time we head over there. I'm grateful she decided to avoid the risk rather than retain it there. But that's what happens when you live in a wall of Washington, I guess. Dirt roads. But Jim, maybe you can speak to this a little bit and how we think and imagine risk.
Oh yeah, I'd be happy to chat briefly on this. We could get into a long. Prima ditatio malorum. And it's really, when I first saw this, I'm kind of an optimist. I thought, oh, geez, this sounds depressing. But really, it's really not a bad thing. What you're doing is you're looking out ahead. You're thinking about things that you might face in the future that could go wrong. And you're deciding which ones are things you need to deal with and which things there's nothing you can do about them, and you just don't do anything about them. And this is important. We do this. This is a big part of our job, is kind of talking to a client, finding out what they have planned for their life. We have a lot of clients. I've had clients that have went from retirement into their 90s now. And so we kind of look out ahead and try to figure out what issues they might be facing or risks they might be facing. And then we try to plan around those risks and try to minimize those risks that could really mess up their plan. And I think that's really important. And that's a big reason why we do planning. It's not just the numbers. It's also, getting a good feel for what it is a person wants their life to be like. And that way we can spend more time, premeditating on the things that could go wrong and try to protect them against those. And technology has really helped us out a lot now. We spend less time with the investment side and much more time on the planning side, and kind of imagining what could go wrong constantly, and taking steps before the things happen to try to minimize the consequences of those potential disasters. Things like healthcare, changes in the economy, things that could affect your income, taxation, all those sorts of things. We try to put a lot of thought into those ahead of time.
Yeah, absolutely. So, Jim, I know this can be a bit complicated, but when we think about risk within our investments and our financial plan, maybe you could just touch briefly on this chart and what this means for that.
Well, there's a lot of stuff on this chart, but I would tell you that with modern portfolio theory, this chart is really key, and this kind of drives really for investments, it drives everything. And it's won a Nobel Prize. But basically, to simplify it, if you take a look at these two lines, and on the lower left corner, you see lower and lower. Okay, if you go to the green line, that curved line right at the bottom, that would be a very low risk portfolio. In this case, that would be all, all bonds, something that's very safe. It has a low return, but it also has a very low risk. As you follow that line around, you notice that it actually there's less risk. And the important thing to say before I get into that is if you go all the way to the end of that line, that's 100% stocks. And you can see has a higher risk. It also has a higher return. And what's interesting about this is that if you actually add some stocks to the portfolio, you actually get a higher return, and you're actually taking lower risk. And really the main reason for that is that they have different risks. So the things that affect bonds are not necessarily the same things that are going to affect stocks. And you could do that with really any two types of investments. You could use real estate and stocks. You could use bonds and real estate. You could use small companies and large companies. You could use non-U.S. or U.S. companies and non-U.S. And the point is that when you blend these things together, it actually will give you a better return, less risk, less volatility, and better return.
Nice. Well said. AJ, speaking of, diversifying, did you maybe want to speak to that a little bit?
Well, I just think to reiterate the concept of buckets. The whole idea of the money will be there when you need it, and the money that you don't need anytime soon will be there further down the road. It's that idea of liquidity, longevity, legacy. So we've got different asset classes filling different needs. So that if there's short-term liquidity needs, we're not taking it from the intermediate term bonds or the long-term stocks.
Yeah, exactly. Perry, I mean, we've talked about buckets a little bit. I know that you're a pretty big proponent of this. Did you have anything you wanted to add to that?
Well, I think we've covered it quite extensively, but the important thing is just to make sure that the money that you're planning for long-term use, you think of it differently than the money that you're planning to spend in the next year. If I was going to buy something in a year, I wouldn't take a lot of risk with that money. But if I'm not going to touch this money for 5, 10, 15, 20 plus years, then I can have a different view on that money and the amount of risk that I'm able to take, because I'm not going to need to spend it right away. So even if things do go wrong, as long as I allow enough time, I'm probably going to be made at least whole or have a better possibility of a positive return in the long run.
Exactly. So, we're kind of winding up here towards the end. Rather than covering all of these questions, these are just some things that we think about, some of the questions that we see asked the most often from a lot of our clients. There's ones that maybe aren't such a big deal for some people, and others that are hot button topics, and we help them analyze which risks we don't need to worry about and which ones deserve our attention and our resources. These are just a handful of them, but they very much are how when we think about risk, these are the things that we're applying that framework to, because they can be complicated sometimes. So anyways, I wanted to thank everyone who tuned in. If you know someone who would have enjoyed this webinar or found it useful, we're actually posting a replay of this on our YouTube channel, or for those of you who may actually be watching it on our YouTube channel, which is great. If you have further questions, there's a good chance you might have a webinar about it as well. Don't hesitate to reach out to us if you have questions or you are interested in some of these things that we brought up. We also welcome feedback. Feel free to let us know what you thought. Thank you to our panelists for sharing their knowledge with us. Again, we have a lot of knowledge and expertise here in one place. So thank you guys, and we look forward to next time.
And thank you everyone for your time.
Yes, thank you very much.